All right, let's dive into a really interesting investment tool today. It's designed for a very specific purpose, hitting a financial goal on a very specific date. If you know exactly when you're going to need a chunk of cash for a house, for tuition, whatever it is, you are definitely going to want to see how this works.
You know that classic investor's dilemma, right? You absolutely need your money to grow, but at the same time, you're just terrified of the market's wild swings, especially when you have a big deadline looming. You want all the upside of investing, but you just can't afford a huge downturn right when you need to cash out.
I mean, think about it. Maybe you're saving up for a down payment on a house, and you know you'll need that money in, say, 5 years. Or maybe you know the exact date your kid's first tuition bill is due in 8 years. Those dates, they're not moving, but the market, well, it does whatever it wants. So how on earth do you bridge that gap?
Well, this is exactly where a special kind of investment comes into play. It's one that's designed for this very challenge. It's called a target maturity bond fund. And honestly, the best way to think about it is as an investment with its own built-in expiration date, one that's perfectly timed for your goal.
So, what is this thing exactly? Well, a target maturity bond fund is basically a collection of bonds that are all set to mature in the same target year, let's say 2030. Now, when 2030 rolls around, the fund doesn't just keep going, it liquidates. It cashes everything out, and the principal, plus all the interest it earned, gets returned to you, the investor. It's designed with a very clear start and a very definite end.
Let's just quickly walk through its life cycle, because it's pretty neat. So, step 1. A fund is launched with a target year, like 2035, and you put your money in. Step 2. The manager's main job is just to buy and hold those bonds, collecting those steady interest payments. Now, step 3 is where it gets really cool. As that 2035 date gets closer and closer, the fund's risk profile naturally starts to go down. And finally, step 4. In that target year, it all wraps up. The fund liquidates, and the money comes back to you. Simple as that.
Okay, so that third step, where the risk just naturally decreases over time, that is the secret sauce here. That's the mechanism that really helps tame market volatility and makes these funds so different from, your standard bond fund. Let's break down exactly how it works.
So to really get it, let's put it side by side with a regular bond fund. A general fund is always buying and selling bonds to keep its risk profile the same. That means it's constantly exposed to those unpredictable swings in interest rates. A target maturity fund? It does the exact opposite. Its whole strategy is buy and hold. And by just holding those bonds until they mature, its sensitivity to interest rate changes naturally shrinks over time. The goal isn't general income anymore. It's all about delivering a predictable return on a very specific date.
Here's a really great way to think about it. It's like a train pulling into its final station. When it's miles away, the arrival time might seem a little fuzzy. But as it gets closer and closer, its arrival becomes almost a certainty. It's the same idea here. As the bonds in the fund get closer to maturity, their market value naturally gets pulled toward their face value. That's the amount they're guaranteed to pay back. And that's what really reduces the volatility as your big day approaches.
But of course, no investment is a sure thing. I mean, come on. For all of its advantages and predictability, it is so crucial to understand the trade-offs. So let's be totally transparent about the potential risks you really need to be thinking about.
You've basically got 3 main risks here. First is credit risk. What if one of the companies or governments that issued a bond in the fund goes bankrupt and just can't pay its debt? Well, that would obviously affect your final return. Second is liquidity risk. Remember, these funds are designed for you to hold them to the very end. If you suddenly need your money early, you might get hit with extra fees or have to sell at a loss. And finally, if your fund invests in overseas bonds, there's currency risk. Big changes in exchange rates could chip away at the value of your return.
So with all of that in mind, the unique structure, the benefits, and yes, the risks, the big question really is, who is this actually for? Because it's all about matching the right financial tool to the right job.
And the answer is actually pretty straightforward. These funds are pretty much tailor-made for investors who have a specific amount of money they need on a specific date. It's really for the person who values predictability and a clear finish line more than they value chasing the absolute highest returns in a crazy, volatile market.
So let's bring it all back to those examples from the beginning. If you're that person saving for a down payment in 2029, or you're planning for that tuition bill in 2032, this could be a really great fit. It lets you align your investment directly with your life's timeline, and it offers a much smoother ride than you'd get from the stock market. The key thing, and this is so important, is that the end date of the fund matches the due date of your goal.
Ultimately, some investment strategies are all about the journey. They're about exploring different paths to try and get maximum growth. This one is all about the destination.
It's for when you know exactly where you need to be and exactly when you need to arrive. So the real question you have to ask yourself is, does your financial map need a clear, fixed destination?